right. Good to see everyone again. We have some fantastic guys here that know a lot about stablecoins. I'm really excited to kick it off. So I'm just going to run it straight down. You guys do a quick intro, a little bit about your background and why stablecoins. What interests you?
So I'm Mark Lurie. I'm an entrepreneur, once upon a time venture investor, and on my third venture-backed startup now. Shipyard builds decentralized exchanges. So we built an exchange called Clipper. It is a DEX for blue chips with better yields, and because better yields, better prices, and because better prices, lots of trades. And we swap a lot of stable coins because, you know, probably over half of trade volume in DeFi is between stable coins and Ethereum. And that's also led to a number of other projects we do related to stablecoins because they're one of the biggest growth areas and opportunities in crypto.
Awesome.
Awesome. Good afternoon, everyone. Excited to be here. Hovanes Galvakian with Nuvei Technologies. My team and I, we oversee Nuvei's digital assets business, ranging from Canada down to Argentina, essentially addressing the Americas markets. We specialize in working with digital asset use cases, traditional payments, anything global payments, and ways that we can make things essentially faster, cheaper, more secure. And so stablecoin is one of these avenues that we're exploring. Happy to be here with you guys.
Great.
My name's Evan. I'm an engineer with Fidelity Digital Assets. I've been building software in the cryptocurrency space, focusing on DeFi and TradFi for a few years now. And you can't have, well, you can. You shouldn't have DeFi and TradFi without stablecoins, which is why I'm obsessed.
That's awesome. So here we have DEX, TradFi, TradFi BizDev, and TradFi Engineer. So it should be a really interesting discussion and talk about stablecoins. So Mark, I'm going to kick it to you. Can you kind of do a baseline, a level set of what a stablecoin is? How does it work?
So stablecoins can mean a lot of different things to a lot of different people, and the word is thrown around a lot. So here is what you need to know about what a stablecoin actually is. The classic example of a stablecoin is Tether, which is USDT, or Circle, which is USDC. There's about 200 billion, somewhere between 150 and 200 billion, depending on the week, of stablecoins outstanding. And the way this works is if you want to get a stablecoin, you can go to Tether or Circle and you wire them $1, and they will give you one token, USDT or USDC respectively. Okay, and then you can send that around to whoever you want, and if anyone wants to, they can always give it back to Tether or Circle, and Tether or Circle will wire them $1. So it's basically like $1 that you can send around. Okay, now, why is this useful? Well, it's the only way you can really send dollars instantly. It's kind of a bearer asset you can send around, right? Going through the banking system can take a few days. Venmoing, you don't see it in the background, but that actually can take some time to settle. You know, the alternative is you have gold, that's a bearer asset, or dollars cash, but then you have to physically transfer it. So this is a way to digitally transfer dollars kind of as a bearer instrument. That has a lot of benefits, which I'm sure we'll get into. These are some of the most profitable and biggest companies in crypto. So Circle and Tether, they take that money, right, call it about $200 billion worth, and they don't just hold it in the bank account, they buy US treasuries, which yield about 5%. And they just keep that 5%. That's a great business. So Tether is earning 5% on, say, $150 billion. They earn over $1 billion a quarter, supposedly have under 100 employees. They're minting money, and that's big business, and that's why hundreds of stablecoins are being minted, and everyone with their own distribution wants to get in on the game. Okay. Now that's stablecoins, and there's a bunch of opportunities to disrupt the financial system and make it better. But there's also these kind of derivative concepts of stablecoins that, you know, people call stablecoins but aren't necessarily stablecoins. So, for example, algorithmic stablecoins are ones that aren't backed by dollars in a bank or US treasuries. Probably the most popular is DAI. This is from MakerDAO. And it's backed by Bitcoin and ETH that's kind of held in a smart contract. And you can redeem the DAI for $1 worth of this kind of underlying assets. Essentially, that's a simplification, but there's about $5 billion of that outstanding. And that doesn't rely on any banks, which has a lot of interesting properties from a compliance perspective. Then there's newer stablecoins like Athena, and this is really a structured financial instrument. So Athena takes your dollar and it buys some ETH and then earns yield on that ETH, and it goes short ETH on an exchange and gets paid a funding rate and combines that together, and you basically have delta neutral yield on your dollar. Is that really a stablecoin? It's not the same as dollar in the bank, but it generally makes money. So people call all these, and there's about 2 to 3 billion of that. So people call all these things stablecoins, but they're really very different concepts. And I think most of what you'll hear at this conference and in this panel is really around the traditional concept of stablecoins, which is backed by a dollar in a bank, or really, investment grade asset held in a custodial account.
Cool. So the yield is of interest. Is there something here around a reduction in transaction fees or something else that maybe the industry would be interested in?
Yeah. So, if you send dollars today across borders, it goes through SWIFT, which is basically a coordinating system, which is jointly owned by the banks of the world. That can take a couple days. It can cost $20, and there's a non-trivial failure rate in the single-digit percentages. And for emerging markets, that's like even, it's even worse. Sometimes you can't get payments through at all, okay? Not to mention it has to go through a bunch of compliance departments and often have reviews. So if you do it with stablecoin, it settles through this international permissionless blockchain. Anyone can have a wallet. So that's basically instant in minutes, if not seconds, depending on your chain, and is only a few dollars to a few cents, depending on your chain. And so those are really, really interesting properties that make stablecoins increasingly used around the world for payments. And I'd say, there's really 3 distinct use cases that take advantage of this. About a third is used for payments. So a third of all stablecoins are held in individual people's wallets, and it has moved in the last 30 days. Another third of all stablecoin balances are held in individual user wallets and has not moved in 30 days. That's used really as a store of value or like a dollar-denominated bank account. If you live in Argentina, you might want to store dollars. You're probably doing it with USDC or USDT. And then another third is held in financial applications like Coinbase, exchanges, DeFi, and that's really like, you can think of that as a trading instrument. You think ETH's going to go up tomorrow, so you buy ETH. You think it's going to go down, you swap back into dollars, then the next day you go back to ETH. So it's really a trading instrument, probably rotating very quickly. And those are 3 distinct use cases that like these properties of a stablecoin. But it's important not to confuse the conversations, because one thing with 3 use cases is often difficult to understand. Each of its characteristics are beneficial in a different way for the different use cases.
Cool. So it seems like there's a lot of interest here for TradFi. So Evan, I'll kick it to you. You mentioned when we were talking before that you build the back-end rails for Fidelity. Can you talk a little bit about what, non-confidentially, what you guys are interested in and why these aspects of stablecoins are good for business?
Yeah, absolutely. So launching a token is technically very simple, right? Like, we might have heard of like pump.fun and similar web applications where it's like 3 clicks, fill out a couple forms. You can launch a token, and that token will move really freely, instantly, right away. And that has a bunch of great properties, where the big concern then is compliance, right? Like, I could tokenize the money in my wallet today, but that would be really sketch if I started issuing like money in Evan's wallet coins and started trying to square them up with everyone. So all the work is in compliance. Things like travel rule. Do we know where money is moving from place to place? Things like KYC. If the Department of Justice says, hey, imagine you're a stablecoin issuer and your stablecoin falls in the hands of the Lazarus group or something. You need controls around how these coins move. You can't say, if you're a U.S. domiciled business, you can't say to the Department of Justice, it's crypto, champ. It's it's not our keys. So that is the biggest concern, and where a lot of the improvements can be made. Right, I've seen a lot of DeFi companies or like bridging TradFi, DeFi companies that are basically regulatory arbs that are like, oh, to do this kind of transaction was a bank wire and a building full of accountants and another building full of lawyers, but now using stable coins and maybe a permission list or ZK proof, there's a bunch of different startups doing a bunch of different problems. We can get this transaction cost down. We can get this transaction time down. But a lot of weird, interesting things result, as you can increase the velocity of money, reduce friction as money moves around, price becomes a more perfect signal, and everything gets weirdly financialized. So the more friction we can remove from the system, the more products can be exposed, and the less work we can all do, which is always nice.
Makes sense. And Hovanes, you're in biz dev, so I feel like this could be an easy conversation. Can you take us through your thoughts and what you're thinking of on the industry?
Yeah, I mean, I like to kind of look at it from like a inspirational or market drivers perspective. Personally, for me, this is as big as the internet. And I'm gonna let that kind of sink in for a second. This has the potential to be the currency of the internet. And I was joking with Garrett earlier. I was like, "Hey man, it's Friday the 13th. I want to wear my hockey mask here and show up. What do you think?" But I think that statement in of itself is kind of scary enough in terms of the innovation ahead of us. So ultimately, there's this underlying demand and desire, whether it's the underserved, underbanked markets around the world. And I think being able to kind of complete that gap, fill that gap with technology and with the rails of traditional and the backbone of traditional finance, I think this is what really intrigues the market. You look at things across you look at technology and the way things have disrupted across the world. We've got a cyber truck in that parking lot, right? So we've got smartphones, we've got all kinds of things that's around us. But overall, the way that we send money across borders and the way money moves around the internet is still kind of it needs that upgrade, essentially, whether that's replacing certain legacy systems, whether that's upgrading them with added technology. So these are the main movers that I see from my perspective that are really fueling this fire.
Yeah, that makes sense. So this is actually something we're looking at in our company too. So we're a healthcare-focused company. We do private data transactions, but we're also looking globally. And stablecoins are of interest for us because that allows us to then actually be better, faster, cheaper than anybody else in the market because we have Web3 rails and we can accept them before others. So this sounds great, and as a business owner, I love it because anytime you can make it go faster and cheaper, that gives you a competitive edge. But there's a regulatory blanket, if you will, that is over the entire industry, even stablecoins. I'm going to kick it to you, Mark. Can you walk us through kind of the challenges that we have from a regulatory perspective here and internationally?
Yeah, so crypto is often thought of as the Wild West, but stablecoins are not really the Wild West. And here are some ways to think about why that's not the case, right? Just because something's a new instrument doesn't mean all the old rules don't apply. So stablecoins have found a whole bunch of applicable laws and regulators that they can kind of fit under. It's a little bit square peg, round hole, but it mostly works. Okay, so in the US, Circle is a money services business. It's regulated by FinCEN, which is the US Treasury. But it has to go and get money transmitter licenses state by state, so it also answers to all these state regulators. And those come with a bunch of requirements, right? They come with KYC requirements, and they come with money laundering requirements, and these tokens implement these, right? Another structure is a New York trust company. So Paxos is a stablecoin issuer. It's regulated by New York Department of Financial Services. It is behind PayPal's dollar, PYUSD, was behind Binance's dollar, and a number of others. And this is just a different regulator and a different set of requirements, which broadly speaking have some similar components. KYC, AML, you actually have to have the reserves. And that's why most of these stablecoins actually have a lot of functionality for compliance. All of these stablecoins can freeze, they can seize, And of course, they can monitor the transactions that are going on. So it's not really as much as the Wild West as people think. Now, algorithmic stablecoins are a whole nother thing, but let's put that aside for now. The issue is that these regulations weren't really written with stablecoins in mind. And so there's very clear rules. They just aren't they sometimes conflict with each other. And they're not, it's just, they're a little, the thing is a stablecoin isn't the same as Western Union. And a stablecoin isn't the same as a bank. And so some of these requirements don't make sense and add a headache. But increasingly, these laws are getting codified and solidified. So in the EU, there's MiCA, which explicitly says, okay, we recognize stablecoins as a separate thing, and here are the rules for it. In the US, there's a bill sponsored by Senator McHenry, I think, which has been debated and creates this class of stablecoins with separate rules that make sense for it. And so stablecoins are regulated today, and those are relatively clear. There's just a few ways to go about it. But increasingly what we have and what we need is legislation that was written with stablecoins in mind as a new financial category. And that's a lot of what we've seen around the world and increasingly will be in the US.
Evan, I saw you enthusiastically shake your head. What do you think that looks like? Tell us your thoughts.
A market structure bill. I would cry tears of happiness if Congress would pass a market structure bill to provide clarity for the crypto market generally, but in particular stable coins, which exactly are can be shoehorned into existing banking regulation, but there's a lot of rule by enforcement going on. There's a lot of feeling around in the dark going on. Just kind of inching products along and hoping you don't get sued for putting these things forward. Just front and center of my mind. Even a bad bill would be better than no bill. Just any kind of market structure to operate within would remove this ambiguity that plagues our industry.
I mean, imagine you're like a major financial institution, a major bank, and you're like, we want to use stablecoins to settle, right? And your compliance department goes to it and you say, okay, well, they say they're a money transmitter, but it's kind of like mostly a money transmitter, but I don't know, like this one element seems a little different. And the compliance department says, what is it? And you say, well, you could think of it as a trust company, right? But then that also doesn't quite make sense. And so they're like, what, let's just...
Regulators love when you're all coy and going, maybe it's this kind of... I can't answer any of your questions. Lawyers don't really go for that.
And it doesn't even need to be right? Like, there's been times where I'm talking to a financial institution, they're like, is this legal? And I'm like, well, here's the law. Here's where it says it's legal. And they're like, well, I need you to have a law firm write an opinion letter. Right. I'm like, you want me to have a law firm write an opinion letter that, like, this sentence is this sentence? Like, what... Why? And then law firms are a little nervous to do it because they're liable. They just really don't like doing stuff like that, or it's very expensive. And so, they just calling a spade. I don't know if that's the correct usage of the idiom, actually, but
sounds good.
Would be very valuable because it would just remove people's natural anxiety to things that are new, even if technically there are rules.
Yeah, makes sense. And Hovanes, you mentioned proliferation of stablecoins. This feels very safe to me. This feels like a lot of folks external to Web3 don't like fluctuating tokens. You have to have a conversation with the SEC. Nobody wants that. This seems like a different area, a different opportunity. So you really you kind of see a vision of proliferation. Can you walk us through that? Like, what are you thinking about in terms of growth? Is it safe? Like, does it feel safe and that's why?
Yeah, I mean, I think to answer this question, we want to kind of break down the landscape, the regulatory landscape a little bit. So we've got the Fed, we've got the OCC, we've got the FDIC, each playing their own unique and complex roles in the government, and then you've got the SEC and the CFTC getting a little FOMO on the side, right? So in a nutshell, it's not the most easiest to get all these parties to come to one consensus, all while kind of keeping the resilience of what blockchain really is, and ultimately, anytime you have a new technology, there's old systems and there's this new notion that no one's really explored. So stablecoin I don't think from this perspective, like stablecoins and other coins, we shouldn't categorize them in the same category. We heard about like the different categories earlier this week. So I think stablecoins in and of themselves, they have this structure that's intended to be safe. It's intended to be useful. And overall, from my side of things, I think based on the way that it's backed, the way how it's backed one-to-one, how it has its required reserve, the important part is to have the right framework in place and have the right structure in place to be able to prevent sort of any kind of illicit activity or any kind of bad actors. Mark, you mentioned about the algorithmic ones. We saw kind of like Tether play and explore in this. Not Tether. I'm sorry. Terra Luna kind of explore in this department a couple of years ago, and it ended up failing. Miserably, and it kind of gave stablecoins this bad rap. But in this instance, I don't think this is in the same conversation.
And in fact, those that were in the industry and engineers or had kind of a deeper knowledge saw the collapse of Luna coming because their business model was fundamentally flawed. Like everyone knew this was coming a year and a half before, and they had thrown sirens out, and no one really paid attention. So I think it did give a bad reputation to algorithmic stablecoins, and I think there's kind of more of a future there. So I'm going to kick it down the line. What do you guys think from a future perspective? What are you thinking? What are you seeing in terms of opportunities?
Well,
or use cases.
Yeah, I think stablecoins are going to be built into the fabric of everything as they, as clarity comes. And I don't think that's going to happen fast because there are a lot of rules that just like aren't helpful and don't give them the same parity in the financial system. But once they are, it's, most of the apps you have are going to use stablecoins in the background. But there are going to be a few unanticipated side effects of stablecoins. One is dollarization. Like what you see is stablecoins are 99% US dollar. But there are stablecoins for other currencies, and no one uses them because it turns out that people prefer dollars globally. And so you might see increase in dollar dominance, and that's going to create some geopolitical tensions around the world. And then other things you're going to see are, the regulatory system is going to need a complete overhaul. So right now we have this thing called the Bank Secrecy Act, and it says you have to do KYC and you have to do all these things. And the spirit is to prevent money laundering, but it actually prescribes how you do that, and that doesn't really make sense. It's not the only way to stop money laundering, right? There's other ways, right? And so over time, as this becomes more and more of the economy, the global regulatory system is going to have to adapt either by passing a whole new regulatory framework or by backing off the specificity of the rules. And that's going to have big impacts because a lot of the cost and frustration with banking is actually in compliance to those rules. And so, that will lead to a lot more people being banked around the world, and that has really positive benefits for everyone.
Do you think we'll see a bit faster adoption if applications implement it first? So if it's kind of the back-end rails where the end users don't see what's happening, could we see a faster adoption than enterprise adopting it?
Yes, but I think it's going to be a little bit of a step function. Like, the enterprises won't pay attention until there's enough consumers and people. The fastest movers are the early adopter individuals. They don't have to get anyone's permission. Yep. You're already seeing that. Okay, and as this volume picks up and holdings pick up, it's big business now. The enterprises are like, oh, we gotta get into this and get behind this. When they turn on, you see an order of magnitude step function. And then once that step function has happened, then you have the late adopting consumers who are like, oh, this is a real thing now that like my bank supports it. And then you have another step function increase. And that's probably how we'll actually see it play out as enterprises pick it up and get into it. And I think they know they have to, which is why they're all piloting things.
Yep. Do they know they have to? Does Fidelity know?
You have a job.
Well,
Yeah.
You never know.
What are you thinking from the industry? What are you guys seeing?
I think my joke well, it's not even a joke answer. It's a serious answer phrased silly. I think it's going to get crazy. As money moves faster, as price acts more as like a pure digitized signal, and as you can move, any asset from any chain for anyone, then the whole internet's going to financialize in this really weird way where political polymarket election chances are going to impact the price of RuneScape gold, are going to impact of money laundering operations in the third world. It's going to be very strange future. But as the money wants to move, right? Like, in particular, I think you hit on something, Mark, that it's the biggest thing to think about is its political impacts as the world dollarizes, U.S. dollarizes or not, as emerging. Castle Island Ventures just put out this great document on stablecoins in emerging markets. I highly recommend it. People are using it to hedge exposure to their own currencies, as you mentioned. People are using it to bridge into crypto, as you'd expect. And as a last thought, I wonder if it gets easier to comply with stablecoin regulations and it gets easier to issue stablecoins. Well, it's very lucrative to issue a stablecoin. If these all have liquidity against each other in the background, is every bank issuing a stablecoin? Is every institution issuing their own stablecoin? I wonder, because that's 5% on a bunch of money that's sitting there is very attractive.
Stablecoins as a service?
Maybe.
Yeah. So we're going to open it up. Or anything else you want to conclude with, or do you want to open it up to the audience for questions? Questions?
Can any of the panelists sort of speak to the potential around backing stablecoins with tokenization of deposits, transferable CDs, and also what the potential role of credit unions might potentially play with this expanding ecosystem of liquidity providers into the stablecoin ecosystems?
So I would guess that, well, I wouldn't guess. It is the case that the major stablecoin issuers take the dollars, and it's not dollars held in a bank account, right? That, in a sense, would be a tokenized bank deposit. And instead, they are buying assets that yield. So we would like to think that's all U.S. Treasuries. In reality, it's not. They want more yield, and they go into money markets, and they buy CDs that may have some duration risk, and they might buy, other investment-grade assets. They may even, for a small portion of their portfolio, go really out the risk curve. They might buy Bitcoin, which Tether is rumored to have done. And so really these stable coins can be backed by anything. I mean, in the case of DAI, which is algorithmic, but it's probably the least funky of the algorithmic ones. I mean, it's just really what it is. It's over-collateralized by like BTC and ETH by a lot. I mean, I don't know, but it's probably like 60% over-collateralized or something huge. So like that's backed by ETH and BTC already. I don't know about, I guess, wrap Bitcoin, probably. I don't know exactly what's in their reserves, but the point is that's what all these are. Yeah. That's separate from, I think, tokenization of those specific financial instruments, right? So tokenizing bank deposits is something that my understanding is JP Morgan is trying to do in its closed system, so you can kind of transfer those around between banks. And then tokenization of, there's a lot of real-world asset companies that are trying to wrap a traditional financial instrument to deliver just that instrument to people. That's not necessarily thought of as a stable coin because it's not $1 to $1. There might be other benefits to it, but it makes it a little harder to use as like a payment method and a unit of account, which is a big purpose of currencies in general.
Yeah, I mean, my short answer to it would be like banks are generally conservative, so it all depends on the underlying asset behind it, backing it. So.
I'd also maybe say that to credit unions, I mean, the reason credit unions still exist, I mean, they're losing share to these big banks, but the reason they exist is because they have a lock on some customer base who wants to use them, right? And what you'll see as everyone wants to get into the stablecoin business is that anyone with their own locked-in distribution is going to issue a stablecoin, right? And so just like anyone who can issues loyalty points, Amex does it, hotels do it, everyone wants to get in on the game if they own the customer, right? And so anyone who owns some customers is going to want to issue their stablecoin. They're not going to compete with USDC or USDT. They're not going to win the whole market, but they'll work within their own users. And perhaps individual credit unions will do that with their users, and this will could give them a new lease on life if they're forward thinking about it, because they're earning more. They're earning they basically don't have to pay interest on those, what are essentially deposits. So I would encourage credit unions to get into it, but the tech lift is trivial in the scheme of technology, but material for a credit union.
Yeah, makes sense. Awesome. Well, thank you guys very much. Really appreciate it.